All right, welcome to This Explainer. If you're building a company right now, well, you already know the old playbook is basically burning before our eyes. The 2026 venture landscape, it is completely unforgiving to that whole growth at all costs mindset. So today, we're decoding the mathematics of sustainable, long-term business growth. And we're kicking things off with a pretty stark reality check. Aggressive scaling, the kind that always gets celebrated in the headlines, it's very often just a dangerous illusion. It looks like success, sure, but underneath the surface, it's a completely different story. In fact, there's this saying going around the ecosystem right now that should honestly send a chill down any founder's spine. It goes, most founders think they're scaling, but they're actually sprinting toward a cliff. Just let that sink in for a second. It really shatters that complacency we so often see in the startup world, doesn't it? Because as a focused learner, you know surface level success just isn't enough anymore. If you don't understand the underlying math of your business, your rapid expansion isn't a victory march at all. It's literally a countdown. Which brings us to the absolutely vital question of this entire explainer. Does your top-line revenue actually mask internal financial decay? We are so conditioned, right? We're conditioned to celebrate every single dollar of top-line growth. But what if that soaring revenue is really just a smokescreen hiding a fundamentally broken core? Well, let's dive in and find out. Section 1, the Revenue Vanity Trap, exposing the 2026 venture landscape. So this myth of revenue-first scaling is incredibly dangerous. Top-line growth? Sure, it looks fantastic on a chart, but it's the ultimate vanity metric. Beneath that lies the actual survival reality, internal financial decay. That outdated blitzscaling mindset taught us to just grow at all costs and, figure out the profits later. But in today's environment, aggressive expansion often means you're spending $1.50 just to acquire a single dollar of revenue. Your rapid growth is actively, literally eroding your core capital reserves. And the mechanism behind this decay is what we call the silent killer. It's this hidden lag, a massive timing discrepancy. See, you pay for marketing, sales, and onboarding right up front, in hard cash. But the actual profit, that trickles in over months, sometimes even years. And this hidden lag is the exact moment aggressive expansion bleeds you dry. You're hemorrhaging cash today for a profit tomorrow that, honestly, might never even arrive. All right, let's move to Section 2, decoding true unit economics, stripping away the fluff. To really build our framework here, we have to look closely at the LTV to CAC ratio. Forget the dry textbook definitions for a second. Think of this as the actual mathematical friction between what a customer brings in versus what it costs you to drag them through the door. This friction actively dictates your long-term survival. It tells you, without any sugarcoating, whether that user base you're so proud of is actually a golden asset or just a mounting liability that's rapidly draining your runway. And look, you absolutely cannot rely on the ad spend math from 5 years ago. Today, calculating your true cost of acquisition means factoring in some pretty brutal new realities. You've got rising AI-driven marketing premiums on one side and incredibly expensive human capital overhead on the other. Both of these forces are squeezing your margins tighter than they have ever been. If your unit economics ignore these 2026 premiums, well, your financial foundation is essentially built on sand. So how do we fix it? Calculating your true lifetime value requires radical honesty. First, you establish a baseline, sure, but then, step 2, you must ruthlessly account for modern churn patterns. Because let's face it, customer loyalty is at an all-time low. And finally, step 3, you absolutely have to factor in 2026 subscription fatigue. Consumers and businesses alike are actively hunting for subscriptions to cancel right now. You just have to remove all that optimistic guesswork from this calculation if you want to see the true mathematical health of your business. Section 3, finding the inflection point from capital consumption to sustainability. Now, healthy base margins in a vacuum, they mean pretty much nothing. You have to stress test your business against the harsh reality of economic volatility. What happens to your runway when market interest rates fluctuate wildly? Or, when global supply chains just shift overnight? Sustainable growth requires knowing exactly how your margins hold up when the external environment suddenly turns hostile. Because your ultimate goal here is the shift from relying on external funding rounds to fueling your business purely through organic reinvestment. Your survival depends entirely on identifying and reaching this exact mathematical inflection point. It's that beautiful moment where your data-driven frameworks take over from the guesswork, and your growth is finally being funded by your own profits, not by continuous dilutive venture capital. Moving into Section 4, optimizing growth and cash.
fixing operational bottlenecks.
This right here is the ultimate balancing act. It's the one that keeps founders staring at the ceiling at 3 a.m. You are constantly torn between this aggressive pursuit of market share and the absolute defensive necessity of maintaining a healthy cash runway. If you lean way too far into market share without dialing in the right unit economics, boom, you triggered that internal financial decay we talked about earlier. You just have to balance these forces to ensure your liquidity remains high enough to survive any unexpected shocks. So what's the most effective way to defend that liquidity? You tighten the payback period. Remember that silent killer lag we discussed? That agonizing time between your cash flowing out and the profits actually flowing in? You need to fix the operational bottlenecks that cause that mathematical friction and slow down your capital turnover. Because the faster a dollar comes back to you as profit, the faster you can organically reinvest it. The velocity of your capital is absolutely your strongest defense against financial decay. Finally, Section 5, Architecting Long-Term Resilience, Preparing for the Future Economy. This is the chronological roadmap you really must follow if you want to escape cash-burning blitzscaling. You start in the capital consumption phase. Look, that's just unavoidable when you launch. But you have to actively build a bridge to phase 2, aggressively tightening that payback period. Because only then can you finally arrive at phase 3, a self-sustaining ecosystem that actually fuels its own expansion. This isn't just a nice theory, it is the required path to build a modern mathematical fortress. And to stay in that self-sustaining phase, your real-time financial dashboards need some rigorous preventative care. First off, you must fundamentally replace a focus on gross volume with a strict, unyielding focus on contribution margin. Repeat after me: volume is vanity, margin is survival. Second, future-proof the business against volatility by building diversified revenue streams. And third, all of this requires a complete shift in founder mindset. You have to leave temporary blitzscaling behind for good. At the end of the day, it all comes down to this core philosophy: mastering compounding mathematical advantages over temporary scale. Scaling a business today isn't just about getting bigger for the sake of being big. It's about getting fundamentally stronger. When you master your unit economics, every new customer and every optimized payback period compounds over time. That is exactly how you stop the bleed and ensure your business doesn't just become a memory. I want to leave you with a provocative thought here. Take a really close look at your revenue. Look at your hidden costs and ask yourself honestly, are you building a temporary blitz scale or a permanent mathematical fortress? If your top-line revenue is actually masking financial decay, well, it is time to stop sprinting toward the cliff. Let the mathematics of sustainability guide your true growth. Thanks so much for joining me for this explainer.